February 10th, 2026, 10 a.m. Eastern Time. Pull up the timestamp and look at it carefully, because everything you're about to hear unfolded in less time than it takes to finish a cup of coffee. At exactly 10 a.m., the crypto market looked calm, almost boring. Charts were flat. Traders were easing into their morning routines. Algorithms were doing their usual quiet dance in the background. Nothing unusual. No panic. No warning signs. Just another trading day. Then, 30 minutes later, reality cracked. By 10:30 a.m., nearly $40 billion in market value had vanished. Not slowly. Not over hours. Not after some dramatic headline. It simply disappeared. In half an hour, an amount of wealth larger than the GDP of some entire nations was erased before many traders even had time to refresh their screens. Normally, when markets implode, there's an obvious culprit. A smoking gun. When FTX collapsed, we knew exactly why. When Terra Luna imploded, everyone watched the algorithm unravel in real time. When exchanges get hacked, we can literally trace stolen funds moving across the blockchain. But on February 10th, nothing. No emergency press conference. No exchange meltdown. No government ban. No scandal exploding across news feeds. No CEO getting arrested somewhere tropical. Just silence. And yet, $40 billion disappeared. This wasn't a hack. It wasn't fraud. It wasn't theft. It was something much worse. A ghost crash. A collapse that seemed to come from nowhere, like a glitch in the market's own reality. And the most unsettling part wasn't even the drop itself. It was that for hours afterward, nobody could explain what had actually happened. If you hold crypto, stocks, or honestly any financial asset right now, you need to understand what happened in that 30-minute window. Because what broke that morning wasn't just price charts. It exposed a structural weakness in the financial system that still exists today. This is the story of the silent crash. But markets don't just wake up and die overnight. They get sick first. And crypto had been sick for months before February 10th. Let's rewind 3 days earlier. February 7th, 2026. The first tremor hit, what traders later called the Bitham incident. It wasn't a hack. Nobody stole funds. Instead, it was something almost worse, human error on a massive scale. Somehow, around $40 billion worth of Bitcoin was mistakenly transferred due to an operational mistake. A clerical disaster. A fat finger error at one of the largest exchanges in the world. The funds were eventually recovered. Technically, everything was fixed. But psychologically, damage done. Imagine walking across what you believe is a frozen lake. The ice looks solid. Then suddenly you hear a massive crack beneath your feet. The ice doesn't break. You don't fall in. But now you don't trust it anymore. That's what the Bitham error did to the crypto market. It showed everyone how thin the ice really was. After that, traders became jumpy. Big investors became cautious. Sell buttons suddenly felt closer than buy buttons. Everyone was waiting for the next crack. And they had good reason. Zoom out to the bigger picture. Back in October 2025, crypto markets were unstoppable. Bitcoin surged to nearly $126,000. Optimism was everywhere. And the total crypto market exceeded $4 trillion in value. Everyone looked like a genius. Everyone was making money. But by February 2026, nearly $2 trillion had already evaporated. 4 straight months of grinding losses. Prices sliding lower. Confidence slowly draining. Each bounce weaker than the last. The market wasn't strong anymore. It was dry timber waiting for a spark. A forest that hadn't seen rain in months. Brittle. Fragile. Ready to burn without needing a massive scandal to start the fire. And that brings us back to the morning of February 10th. Retail traders, the everyday investors, were still trying to call the bottom. Social media was filled with posts claiming crypto was cheap and ready to bounce. But the big players? They weren't buying. They were leaving quietly. Hedge funds, institutions, large capital pools were slipping out the back door while retail traders were still arguing about when the rally would return. And this created a dangerous condition in the market. Thin liquidity. Picture a safety net beneath a tightrope walker. Normally, when people sell, buyers are waiting below, cushioning price movements. If someone sells Bitcoin at $90,000, buyers line up slightly lower. Price moves, but not violently. But after months of decline, plus the Bitham scare, plus growing economic fear, those buyers had disappeared. The safety net was gone. So when selling pressure finally started building shortly after 10 a.m., there was nothing underneath to catch prices. It was like thousands of people trying to rush through an exit door that was suddenly locked. And this is where the most dangerous machine in modern finance kicked in. Not fear, not greed, leverage. When prices drop just 1%, it should have been nothing. Crypto moves that much all the time. But this market was fragile. Trading bots reacted instantly. Stop-loss orders triggered automatically, forcing sales to limit losses. But remember, there were no buyers. So prices fell faster. That drop triggered more automated selling. Then more. Then more. A chain reaction. A financial domino effect. Bitcoin fell 2%. Then 3%. Altcoins like Ethereum and Solana fell even harder. Futures traders using borrowed money got liquidated by exchanges automatically. Within minutes, over $1.5 billion in leveraged positions were wiped out, not because traders chose to sell, but because the system sold their assets for them. Selling triggered more selling. Fear fed fear. And by 10:30 a.m., when the dust settled, $40 billion was simply gone. And here's the chilling part. The system didn't malfunction. It worked exactly as designed. The real flaw wasn't code. It was market structure itself. The buyers had vanished, and sellers had nowhere left to go but straight down. But that leads to the bigger question. Why did this happen now? And was this the bottom or just the beginning? To answer that, we need to look at who was actually selling. Because it wasn't small traders on their phones. It was the whales. And whales rarely move without a reason. To understand why the whales started heading for the exits, you have to stop staring at crypto charts for a moment and look at something bigger. You have to look at money itself. For years, crypto thrived in an environment where cash was cheap. Borrowing money cost almost nothing, and banks paid next to zero interest for keeping your savings parked with them. In that world, holding cash felt pointless. So investors chased assets: stocks, tech companies, real estate, and of course crypto. Bitcoin, Ethereum, Solana, everything went up because money had nowhere else to go. Risk was rewarded. But by early 2026, that environment had flipped completely. The Federal Reserve signaled something markets didn't want to hear. Interest rates were staying high longer than expected. And that changes everything. High interest rates act like gravity in finance. When rates rise, safe investments suddenly become attractive again. Government bonds start paying real returns. Cash earns yield. Risky assets stop looking so appealing. So the whales didn't dump crypto because they suddenly hated Bitcoin. They sold because the math changed. Why risk losing 20% in a volatile market when you can earn a steady return in safe assets? And this shift triggered something most retail traders barely noticed, but professionals watch very closely: the stablecoin outflow. Think of stablecoins like USDT and USDC as poker chips inside a casino. As long as your money is in chips, you're still in the game. You might not be betting at that moment, but you're still inside, ready to play. But in January and early February, something unusual started happening. Investors weren't just selling crypto into stable coins. They were cashing out completely. They redeemed their stable coins for actual US dollars and wired the money back to their bank accounts. They were leaving the casino entirely. And when money leaves the system, something critical disappears: dry powder. Dry powder is cash sitting on the sidelines, waiting to buy dips. It's what normally stabilizes markets during sell-offs. But on February 10th, when prices began to fall and social media screamed "buy the dip," there was a problem. There was no money left to buy with. The buyers had already gone home. This explains why the drop felt so violent. In a healthy market, a massive sell order gets absorbed by thousands of smaller buyers. Price moves, but the system holds. But on that morning, market depth was paper thin. Imagine jumping into a deep swimming pool. You splash, but the water absorbs the impact. Now imagine jumping into a kiddie pool. Water flies everywhere, and you hit concrete. That's what happened when large sell orders hit crypto markets that morning. A small drop triggered massive damage because there was nothing underneath to cushion it. When Bitcoin slipped just a couple percent, the entire ecosystem followed instantly. Ethereum, XRP, BNB, everything dropped together. And normally, a 3% move in crypto isn't dramatic. It's routine. But in 2026, leverage levels were dangerously high. Traders weren't just using their own money anymore. Many were borrowing 10, 20, even 50 times their capital to bet on a rebound. They were expecting prices to bounce, but the bounce never came. And when prices dipped, those leveraged positions became toxic instantly. Exchanges issued margin calls, demanding more funds, but nobody had spare cash left. Remember, dry powder was gone. So exchanges started closing positions automatically, selling assets to cover debts. And that created a brutal feedback loop. Selling pushed prices lower. Lower prices triggered more liquidations. More liquidations caused more selling. Round and round it went. Across global markets, over $1 billion in leveraged positions were wiped out during the sessions surrounding the crash. And that's not just numbers on screens. That's real savings, real money, real financial pain. Money transferred from traders who were overconfident to those who stayed cautious. And something else broke that day. A psychological rule investors had followed for years. For nearly half a decade, every crypto crash had eventually rewarded buyers. Every dip turned into profit months later. People were conditioned. Crash equals opportunity. But February 10th shattered that belief. Suddenly, buying dips didn't feel smart anymore. It felt dangerous, like trying to grab a falling knife. And that psychological shift explains why the recovery afterward was so weak. Yes, prices bounced slightly after the 30-minute meltdown. Green candles appeared briefly, but it wasn't real strength. It was what traders call a dead cat bounce. Even a dead cat will bounce if it falls from high enough. The rebound wasn't fresh money entering the market. It was short sellers taking profits and stepping aside temporarily. Once that buying pressure faded, weakness returned. And analysts who had confidently predicted Bitcoin hitting new highs suddenly started changing their targets. Not upward, downward. Instead of calling for $100,000 Bitcoin, many began pointing to levels near $40,000, even $38,000. They realized the massive losses since late 2025 weren't just a correction. The market was being repriced. Risk was being reevaluated. And crypto still hadn't found its true bottom. But here's where things get even more concerning. If crypto is crashing because liquidity is drying up and interest rates are high, what happens when those same forces hit the stock market? Crypto is often the canary in the coal mine. It reacts first when liquidity disappears. But it's rarely the last market to feel pain. And that means the February 10th crash might not have been an isolated crypto event. It might have been a warning shot, a signal that something bigger is moving beneath the surface. And to understand where the next shock might hit, we need to look at what happened immediately after the crash and why the apparent recovery fooled so many people. Because what traders thought was safety was actually the most dangerous phase of all. By around 11 a.m., something strange happened. The panic paused. Prices stopped falling. Bitcoin ticked slightly higher. Ethereum stabilized. Charts started printing small green candles again. On the surface, it looked like the worst was over. Social media flipped instantly. Traders posted screenshots bragging that they had caught the bottom. Influencers celebrated buying the dip. Optimism briefly returned, as if the market had simply stumbled and was now standing back up. But experienced traders saw something different. They recognized the most deceptive phase of any market crash, the dead cat bounce. The logic behind it is brutal but simple. Even a dead cat will bounce if it falls from high enough. That temporary recovery wasn't new money rushing back into crypto. Confidence hadn't magically returned. Instead, short sellers, traders who bet on falling prices, were closing positions to lock in profits. Once those trades were closed, selling pressure paused. But when profit-taking finished, there was still no real buying power underneath. And the harsh reality became clear. The market trend was still down, and trends matter more than emotions. Since the peak in October 2025, crypto hadn't just corrected, it had been devastated. The entire market shrank from over $4 trillion in value to barely holding above $2 trillion. Half the industry's value gone. The February 10th crash wasn't an accident. It was a symptom, a sign that prices still hadn't adjusted fully to new economic realities. Even after losing trillions, the market still wasn't cheap enough to attract strong buyers. That's why professional analysts weren't celebrating the bounce. They were looking lower. Before the crash, many defended Bitcoin's $45,000 level as a fortress, a line that supposedly couldn't break. But that fortress fell, and now targets were shifting downward. Many analysts began focusing on the $38,000 to $40,000 zone as the next critical area. That level matters psychologically. If Bitcoin falls there, many long-term holders finally give up. The famous "by the dip" crowd disappears. And when hope dies, real bottoms form. But the market wasn't there yet. And this changes how the game works. During bull markets, aggressive strategies win. Investors chase the riskiest coins because they rise the fastest. But in a fragile market that can erase $40 billion in half an hour without warning, aggression becomes dangerous. Survival becomes the priority. And February 10th proved something uncomfortable. Bitcoin and Ethereum, considered the blue chips of crypto, were not safe havens. They fell instantly alongside everything else. But smaller coins suffered even more. Some altcoins collapsed 10% or 15% within minutes. That's the classic flight to safety. When a building catches fire, people don't stop to grab fragile valuables. They grab cash and run. In crypto, Bitcoin is the cash. Everything else is the fragile china. And a lot of china shattered that morning. So where did this leave the market? Liquidity was gone. Big investors were moving into dollars and bonds. Technical charts pointed lower. And retail investors were exhausted. Many had already endured months of losses. They survived the Bitham scare. They survived the slow bleed. Then they watched billions vanish in minutes. Everyone has a breaking point. Markets are brutal. They grind lower until the last hopeful investor gives up. That's usually when bottoms form. But signs suggested we hadn't reached that moment yet. And here's the truly uncomfortable realization. For years, crypto believers insisted Bitcoin moved independently of the global economy. But February 10th proved otherwise. Crypto is deeply connected to global financial conditions. When fear spreads across markets, crypto reacts first and hardest. It's the early warning system. And that warning system was flashing bright red. Because if macroeconomic fear and high interest rates could wipe out $40 billion from crypto so easily, what happens when those same forces hit markets 100 times larger? What happens if liquidity suddenly disappears beneath the stock market? Many investors assumed their portfolios were safe simply because they didn't own crypto. But that assumption might be dangerously wrong, because the same liquidity stress-breaking crypto was beginning to appear elsewhere. And the mechanism behind contagion is simple. The players are the same. Back in 2017, crypto markets were mostly retail traders and hobbyists. But by 2026, hedge funds, family offices, and high-frequency trading firms were deeply involved. The same institutions trading Wall Street were trading crypto. So when a hedge fund loses money in Bitcoin liquidations, they need cash immediately. And where do they get that cash? They sell what's still profitable. Stocks, tech shares, index funds. Losses spread across markets. The fire jumps the firewall. And that's how a crypto crash becomes a broader market problem. Which brings us to the question nobody wanted to ask. What if February 10th wasn't the end of the story? What if it was just the opening scene? To understand that, we need to look at what's happening inside the stock market right now, because the warning signs are starting to look disturbingly familiar. To really understand why this matters, you need to recognize one crucial difference between crypto and traditional markets. Crypto never sleeps. It trades 24 hours a day, 7 days a week. There are no opening bells, no closing bells, no circuit breakers to halt panic when things spiral out of control. Traditional markets have protections. Trading pauses when volatility spikes. Regulators step in. Exchanges close for the day, giving investors time to calm down. Crypto has none of that, which means when liquidity begins drying up across the global economy, crypto feels the pain first. It's the raw nerve of the financial system. And when $40 billion evaporates on a random Tuesday morning, that isn't just a crypto problem. It's a liquidity signal. Smoke before the fire. And remember, today's crypto markets aren't isolated playgrounds for retail traders anymore. The same hedge funds, institutional desks, and algorithmic trading firms operating on Wall Street are active in crypto. Money flows between markets instantly. So when those institutions get hit with losses in crypto, they don't just absorb the damage quietly. They need cash, immediately. And to raise that cash, they sell what they can. Their profitable stock positions, their tech holdings, their index exposure. That's how financial contagion spreads. A crypto liquidation forces selling in equities. Equity losses trigger further risk reduction. And suddenly, what started as a crypto flash crash becomes a broader market problem. And here's what should worry investors right now. The stock market is starting to show the same symptoms crypto showed before February 10th. Trading volumes are thinning. Buyers are becoming cautious. Markets are increasingly dependent on leverage, just packaged differently. In crypto, leverage shows up in futures contracts. In stocks, it appears through ultra-short-term options trading, especially zero-day to expiration options. Massive bets placed daily that expire within hours. The mechanics are nearly identical. If markets drop even slightly, algorithms begin selling. Options positions get forced out. Selling accelerates. Sound familiar? It should. It's the exact same cascade mechanism that wiped out billions in crypto. The only difference is scale. Crypto is roughly a $2 trillion market now. The US stock market is closer to $50 trillion. If crypto sneezes, billions vanish. If equities catch the same cold, retirement accounts, pension funds, and entire economies feel the impact. So what should investors do? Stop thinking like gamblers. Start thinking like survivors. The buy the dip strategy works in bull markets when central banks are flooding systems with cheap money. But in 2026, liquidity is tight. Rates are high. Easy money is gone. And in this environment, cash becomes powerful. For years, investors were told holding cash was foolish because inflation would eat away its value. But cash doesn't drop 40% in half an hour. Cash gives you patience, flexibility, optionality. The investors who survived the February 10th crash weren't trying to catch falling knives. They waited. They watched the market find stability before acting. And right now, markets may still need one final phase before real recovery begins. A flush. A true capitulation moment where exhausted investors finally give up, prices reach undeniable value, and risk resets completely. Many analysts calling for Bitcoin near $38,000 may still be optimistic if broader markets start falling as well. But this isn't about being bullish or bearish. It's about being awake. The rules that worked in 2024 and 2025 don't necessarily work in 2026. Markets evolve, conditions change, and leverage, when misused, can erase months of gains in minutes. The Bitham error was the warning shot. The February 10th crash was the lesson. But the final exam may still be ahead. And here's the most unsettling part. Most people are staring at price charts, hoping for green candles to appear. But professionals are watching something else. Liquidity. Days before the February crash, liquidity heat maps showed a dangerous void, areas where buyers had quietly disappeared. And right now, those same indicators are flashing warnings again, this time in major equity markets, especially in tech-heavy sectors. Liquidity pockets are vanishing. The safety net is thinning, and stepping into those gaps at the wrong moment can be financially devastating. So before you make your next move, understand where those voids are forming. Understand where markets may fall next. Because the next flash crash doesn't announce itself. It just happens. And by the time headlines appear, the damage is already done. So watch carefully. Stay patient. And don't mistake temporary calm for real safety. Because in markets like this, silence is often the loudest warning.